Good afternoon. I'm Peter Henry, Dean of the Stern School, and I want to welcome you to our Economic Outlook Forum. Like our speakers today, we share New York City as our home, and New York is indeed home to some of the leading market economists in the world. And as a result, we have the opportunity to convene three of these very leaders from JP Morgan, Standard & Poor's, and Citigroup to engage in a dialogue with us about the global economy and the forces that are driving and shaping its future. We're in a position to hold these forums because of the leadership of our Center for Global Economy and Business, the host of tonight's event. And on that note, without further ado, I'd like to turn the podium over to my colleague, Kim Schoenholtz, Director of our Center for Global Economy and Business, who will introduce our panelists. Enjoy the conversation.
Thank you, Dean Henry, for that very kind introduction. And good evening to everyone. Welcome to the second Stern Economic Outlook Forum. Thank you very much for joining us today. The program will last about 75 minutes. We'll begin with 10-minute presentations by each of the panelists regarding economic and market prospects. That'll be followed by a short panel discussion that I will moderate. And the last 20 to 25 minutes of the program will be audience Q&A. Let me briefly introduce our distinguished panelists. Starting from close to me, Mike Feroli is the chief U.S. economist at JP Morgan. Previously, he was an economist at the Federal Reserve Board, where he helped formulate the staff economic forecast. Paul Sheard is the chief global economist and head of global economics and research for Standard & Poor's Rating Services, and is a member of S&P's executive committee. Previously, he held similar research positions at Nomura Securities and at Lehman Brothers. Nathan Sheets is the global head of international economics at Citigroup. Previously, he was director of the Federal Reserve Board's Division of International Finance and one of 3 economists to the Federal Open Market Committee. Altogether, he spent 18 years at the Fed. Following alphabetical order, let me now ask Michael to begin the presentations.
All right, thanks, Kim. So given that I only have about 10 minutes to make a few remarks, I'm not going to try and do a comprehensive outlook for the U.S. economy, but instead I'd like to just talk about a few key themes we're looking at as we think about the year ahead. And the first key theme is that fiscal policy will remain important. It has been important over the last few years, and it's going to continue to be important whether you like it or not this year. And it's probably going to be important in a negative way insofar as that it will likely drag on growth this year. Second, housing will also be important this time in a positive direction. So housing and fiscal policy over the last few years kind of switching places. Housing was a big drag on the economy, is now, I think, pretty convincingly a big support for the economy. Third key theme is that we have some negatives, we have some positives. Most of us, as we add it up, get something growth around 2% or something like that for this year. And with growth like that, unemployment will remain high. Finally, just to touch on a little bit of the market outlook, high unemployment means low wages, means low inflation, means low interest rates, and this is forcing investors to grudgingly go out and take on more risk. And I would finally mention that one theme that kind of ties all these themes together is that they are all, in their own way, lingering effects of the 2007 to 2009 downturn. Officially ended 3.5 years ago, but we're still really living in its shadows. So first, on fiscal policy, I should mention that I actually got my PhD at NYU about 10 years ago. At that time, when if you were a PhD and you were studying macroeconomics, you probably had fluency in about 100 scholarly papers on monetary policy. Fiscal policy, we might have known, maybe a half dozen papers. I suspect that's probably changing, though, maybe. I suspect it's changing because it's become increasingly important over the last few years. First, in part because monetary policy, once interest rates got to zero, there wasn't much more that monetary policy could do. So it really fell on fiscal policy to respond to the weakness seen in the crisis in 2008, 2009. The fact that fiscal policy had to respond so aggressively left us in these positions of very large deficits. Got to, as you can see there, about 10% of GDP in 2009. Those large deficits caused some political concern, which has culminated in a series of fiscal fights over the past year or two. And the outcome of that is that fiscal policy is turning somewhat tighter this year. So the beginning of this year, payroll taxes went up for basically everyone. Income taxes went up at the upper end of the income distribution. And it's also likely that we're going to see spending reductions of one form or another later this year. So fiscal policy, we think, may be subtracting at least a percentage point from growth this year as it turns tighter, as the federal government increases taxes and cuts back on spending. Second, housing is, there is a lot of enthusiasm in the markets right now for housing. Any housing-related asset people can't get enough of. And I would say as an economist, it's hard to judge whether people are reaching too far, but one thing I feel pretty confident about is that housing is going to contribute pretty significantly to growth this year. And it's actually a pretty simple story, which is this chart here is housing starts, which is to say how many new homes are built each year or begun to be built. And you can see that from 2008 to about 2011, home building was extremely depressed, running about 500,000 a year. Well, we've got a growing population, even in weak economic times, which implies a growing need for more housing units. For a while, this was being met by all these inventories of unsold homes that were a residual of the crisis. Now we've started to run through some of those inventories. They're getting lean, and home building is starting to come back in a big way. And we think this could add about 0.5 percentage point to GDP growth this year, just from the impact of more home building and more construction activity. It could also have some important knock-on effects if rising house prices lead to greater consumer spending and greater, improved consumer sentiment. So housing is finally, starting to show signs of a normal cyclical recovery. Normally, or usually after a recession, housing comes back really quickly. This time we had all these inventories of unsold homes because we overbuilt during the boom years. Finally seems like we've run through and exhausted or used up all this overbuilt housing stock that we accumulated in the boom years. Third theme is even with housing improving, even with housing providing an important offset to fiscal policy turning tighter, getting back to something approaching full employment is probably going to take a while. As you can see here, unemployment went up to around 10% in 2009. We've come down to just a little below 8% now. And we still think, most people still think normal unemployment is about 5 to 6%. So there's still a lot of unemployment out there. And if we're only going to get growth around 2% or something like that, it's probably going to be difficult to get back to full employment anytime within the next few years. What this has meant, as I mentioned at the outset, I don't have any charts on this, but you can take my word for it, is that wage inflation and wage growth has been very weak. Overall consumer price inflation has been very weak. And so, of course, interest rates are at rock bottom levels, are at zero for short-term interest rates and very low levels for longer-term interest rates. What this has meant is a few things. So I'm not an equity strategist, but just in the interest of kind of tying things up here into some market implications. The left-hand side of this chart is PE ratios based on either trailing or trend earnings. And this is probably something most people would normally look at when thinking about whether the market is overvalued or not. And by this measure, equity multiples are near their historic means, their historic average. Equity risk premia, however, if we want to think about what you can earn from stocks relative to the real yield you're going to get on treasuries, right? So treasury securities, 10-year rates are running about 2%. With inflation expectations somewhere close to there, real rates are, roughly zero, maybe negative in some parts of the curve. And what that means is that relative to treasuries, the return on equities is very high, which is the equity risk premium that you see on the right-hand side of this chart. Sometimes also known as the Fed model, which me and Nathan both like Fed models. So, and what this tells you is that investors have very grudgingly taken on more risk. For a while, very low yields cause investors to go out to some credit products, and now credit spreads are getting very narrow, and people are finally moving on into equity. But it's taken a while for the shell shock and the scarring that happened to people's psyche after the recession to get people to actually move on and take on some risk. So those, again, are a few key themes I just want to touch on. It's not a comprehensive outlook by any means. I do have, for whoever wants it, our numbers here, but I just want to touch on a few key themes, which is that fiscal policy, very likely to be a negative. Housing, we think, is going to be a positive. Interest rates are going to be very low, and that's going to continue to force people to search for yield in other ways. And as I said, I think the one key sort of thing tying all these things together is that in many ways, each of these themes is a residual of the downturn, which is, as I said, downturn ended 3.5 years ago. It's pretty unusual to be living in the shadows of a downturn for that long. When you think about the past two recessions, the one that ended in 2001 and the one that ended in 1991, 3.5 years after the recession was over, the Fed was hiking interest rates and worrying about inflation. So you're already getting to a point of the cycle where things were mature enough that we were actually worrying about inflation. And we're obviously forgetting about the past recession. This time, we are in many ways still living in the shadows of that recession. Hopefully we'll get out of those shadows eventually, but I don't think that's going to be the story of 2013 quite yet. And with that, I will stop and hand it over to Paul.
Thanks very much, Mike, and great pleasure to be here today. So I didn't really hear anything there that I would disagree with, so I will sort of go on and develop the theme. So I want to look a little bit more broadly at the global economy, and the sort of three or four things I would focus on just to frame it really is the first point that Mike raised, that the developed world is still operating in the shadow or with the legacy of the greatest financial crisis and the greatest recession since the Great Depression. And if policy hadn't been moved the way it had been moved, we might have been in a Great Depression. So that force is still having a big impact on the developed economies. Second big theme in the global economy is the Eurozone. The Eurozone, if it was one economy, would be the second largest economy in the world. And of course, we've had the Eurozone crisis in the last couple of years. And to me, that is all about a crisis of a flawed economic architecture, the flawed architecture of a half-built monetary union. In other words, they built the monetary union, they didn't build the fiscal union, and that's come to the surface. Third big sort of force, if you like, or theme in the global economy, to move to the positive, is China. China, of course, is now the second largest economy in the world. It has grown on average since it started opening up in 1979 by about 10%. But even since the financial crisis of 2008, China has grown by 8.9%. That average was 9% and has dipped down because we've had a couple of quarters of weak growth. So that's a tremendous force in the global economy, a tremendous story of economic development, but also a tremendous performance and continued capital accumulation in the most difficult global economic environment since we've experienced since the Great Depression. That's quite an amazing thing. And I could add a fourth one there, which is Japan. The other fact, if you like, or interesting factoid about the global economy is the third largest economy has been in a prolonged deflation. That may or may not continue, but certainly Japan has come back on the radar screen in the last couple of months. So let me sort of go around each of those countries and sort of forces in the economy. Let me start with the Eurozone. because I think the Eurozone is still in some ways the most interesting issue for the global economy and the biggest risk factor. Just in terms of forecast, Europe is back in recession. We think that recession will probably linger through the course of this year, but will come out of recession. But I would also make the point here that now is not the time and place that you want to be going into a recession. 3 or 4 years out from that great recession of 2008, 2009, when economies are weak, that's not the time to go into recession. So any recession is a bad recession at the moment. Unfortunately, Europe is back in the recession. The problem I see in Europe, apropos of that architecture issue, again, just to focus on that point for a moment, is that it's quite problematic when you have 17 countries in the Eurozone coming in, joining a monetary union, essentially all pegging their exchange rates to the Deutschmark, you can think of it that way, but not entering a fiscal union. You can think of it in terms of margins of adjustment, or if you like, policy flexibility. If you're Greece or Italy or Spain, for example, you've pegged your exchange rate to the Deutschmark, to put it that way, you no longer have an exchange rate margin of adjustment, only in as much as you're part of the Eurozone. You no longer have your own monetary policy that you can operate. That's in Frankfurt. Now, you still have fiscal flexibility, but under the construct of the Eurozone, actually that was taken away from you as well, because you had the Maastricht Treaty and you were told you cannot run large deficits. And we saw Mike's chart. In recessions, budget deficits tend to go up automatically. That's called the automatic stabilization mechanism. That's actually a good thing. So these European economies had their policy flexibility limited to a high degree. And it was no wonder then that the market started figuring out, gee, if I have euro debt and that euro debt happens to be in Greece or Ireland or Portugal or Spain or Italy, maybe that's not the same thing as having euro debt in Germany or France or the Netherlands, and maybe I won't get my money back because those countries don't have a central bank that can run the printing presses anymore. And to me, that was the whole crux, if you like, of the Eurozone crisis. So what did they do? 3 things happened last year, which we will have to wait and see how they play out this year. One is that they came out with a plan to fix that architecture. European policymakers, from about mid-year with the June European Council, said, you know what, this is not just about crisis management. We have a flawed architecture. We need to fix it. How do you fix it? Banking union, go down the path of fiscal union, more economic integration, but you also need political union. That's a 10-year project. So talk about crises casting long shadows. The crisis of the flawed European architecture is going to be casting a very long shadow here, not according to me, but according to European policymakers themselves. Second thing that happened was a little bit technical, but more on the crisis management side, they essentially said we're going to use the European stabilization mechanism, this bailout fund, if you like, to try to break the nexus between the sovereign risk and the banking system risk. And the markets liked that. And the third thing, of course, which the markets also liked, was the OMT, the outright monetary transactions that the ECB came out with in September. But Draghi gave a heads up on that with his end of July speech in London, which basically said the market is pricing in default risk into European sovereign debt because the market thinks the Eurozone might break up. It's not going to break up. We're the ECB, we are telling you when it's not going to break up. And the markets listened to that and they backed off. But the ESM and the OMT, neither of those has actually been used yet. So this is a classic case, if you like, of policymakers trying to restore confidence to the market by promising to do something or even threatening to do something. Markets responding, but then the policymakers saying, well, in that case, we don't need to do it anymore. Is this a stable equilibrium? Are the markets going to just sit back and say, oh, okay, we believe all of this? Or are they going to come back and test policymakers, test the resolve of policymakers? I think it'll probably be more on the latter. So it's all now about execution and implementation in Europe. The plans are there, can they follow through? But the other thing in Europe is, somewhat unlike this country, but not completely distinct, is this preference for austerity. The idea that the solution to the problems that the Europeans face is to have a lot of fiscal austerity, to restore competitiveness almost through internal devaluations. That is not a very pro-growth approach, and lo and behold, Europe is back in recession. However, the recession cannot be allowed to get too bad because, of course, that will raise the threat or the prospect of sovereign debt defaults, but they're not going to allow that either, so they have to have some kind of balancing act. Let me move on to the US, and I'll be quick here because Mike has already covered it very well. I see a number of positives in the US, and we're actually got a more positive forecast for this year's growth, maybe closer to the high end of 2% rather than the low end of 2%. What are the positives? Well, the first one is the US is not Europe. I'm only being half facetious there. The US does not have these trenchant problems that Europe has, and that's a positive. Second one is the US is not Japan. And what I mean by that is the US made the right policy moves back in 2008, 2009, and 4 or 5 years later now is in a position where this economy can start to reap some of those dividends. I'm thinking particularly of the banking system, the stress tests, the TARP, etc. That was a great move back in 2008, 2009. Third positive is time. The fact that now 4 or 5 years, or even for the housing recession even longer, has gone by. And so the healing of balance sheets and that deleveraging process that was set in train by the Great Recession is starting to come to an end. It's not over yet, but we're starting to run towards the end of that process. And the fourth positive is the aggressive Fed. Now, there's a lot of talk about quantitative easing. Does it work? Is it sowing the seeds of future inflation? I think the truth is somewhere in between. Obviously, if you've hit the zero bound, if the central bank is forcing to dig deep to go into quantitative easing territory, it's not going to be a very potent tool. But that depends partly on the nature of the economy. If the economy is healing, then it's possible that monetary policy can have a slightly more stimulative effect. And what was very impressive to me was September and December of last year, the Fed came out swinging. They eased monetary policy further with what is now adding up to $85 billion per month of MBS purchases and longer-term Treasury purchases, September and December, those two decisions. But they also made some very important changes to their forward communication, to their so-called forward guidance. And cut a long story short, said, we're not happy with the rate at which the labor market is improving. We want to see a stronger recovery. We're impatient, and we're going to do more monetary easing, and we're going to keep doing that until we see a substantial improvement in the labor market conditions. And as far as zero interest rate policy goes, we're going to keep doing that until the unemployment rate comes down at least to 6.5%. Well, it's up at 9 now. I think it just ticked up. So a long way to go. So the Fed has said, we're on the case, we've got a balance sheet, we're going to use it aggressively to try to speed this recovery up. Now, a lot of people say, well, that's pushing on a string. But if the economy is healing, housing market in particular, as Mike emphasized, potentially you can get a little bit more lift in the economy. The one negative that we worry about is fiscal tightening. And this is perhaps the one lesson from Japan that the US has not necessarily learned. The lesson that in a post-recession and deleveraging environment, you actually do need to run larger budget deficits. Those deficits are helping you to get back to full employment quicker. As we heard from Mike, fiscal drag might be a percentage point in the US this year. Why do you want a percentage point drag on an economy that is still weak? And one arm of policy, monetary policy, is trying to speed it up while the other arm is slowing it down. Now, you might think that's strange coming from a rating agency, but of course, the US needs to put its fiscal house in order. How does it do that? Two things. Make sure the economy doesn't go into recession again. Make sure you get back to full employment as quickly as possible. And secondly, of course, formulate a longer-term, credible fiscal consolidation plan. That's what all the debate on the fiscal cliff is all about. But it doesn't make sense to cut off your nose to spite your face, to force the economy into recession because you want to deal with long-term fiscal challenges. But Washington is, it's like watching the proverbial sausage being made. But if you look at the results that seem to come out of Washington, they do seem to be moving in the right direction, pulling back from the brink of pushing the economy into recession and focusing on the longer term issues. So we're a little bit more optimistic that we might get some good results there. Let me move on to quickly China. I won't say a lot, but China is a real miracle kind of story. It's very much investment-led growth. If you look at the investment share of GDP, 2007, that was 39%. That was already pretty high. They pushed it up just in 2 years to about 46%, so 7 percentage point increase. So that's the secret sauce, if you like, in the economy, how they've managed to keep growing at a very dramatic rate. That capital accumulation, that investment is very good for growth. It's also very good for the infrastructure, for capital accumulation, but it does sow some very difficult challenges for the policymakers. China needs to rebalance. That's become almost a cliche. Consumption, household consumption as a percentage of GDP is only about 35%, which is extremely low. That needs to come up, and investment share of GDP needs to come down. So they need to rebalance the economy while growing at the same time. Investment is a more volatile component of GDP than consumption is. So if investment pulls back sharply, you can't expect from an even lower base consumption to move up quickly enough to offset. So China is facing these rebalancing risks, but I think they're slightly longer term. I would expect this story to play out over the next 5 to 10 years rather than the wheels falling off the growth machine in China this year. So we're looking for around about 8% growth or so. The challenge is going to be, it's all very well to say, well, we're going to rebalance the economy, but the kind of economic architecture that you have in an economy which is investment-led, and the sort of economic policy architecture that you need when you're trying to stimulate consumption are quite different. So that's China. Perhaps I'll leave Japan for the Q&A session. Thank you very much.
Well, I am very happy indeed to be here to say a few words about the global economy. I think we're broadly in sync, and I think it's the first time that I can recall that 3 economists have agreed on anything. So this is very much a landmark day. We'll have to find some things to disagree on in the Q&A portion. But let me just give you a little bit of background on the way that I'm viewing the world at present. Starting off here is a chart that shows you global trade volumes, and I'd like you to focus on that. That's the red line. And what you see here is a very nice summary of where we've been and where we are now. The global trade volumes collapsed sharply during the global financial crisis in 2008, 2009. Then, as often happens following the collapse, there was a pretty solid rebound in global trade through 2009 and 2010, with 12-month change rising something above 20%. Nobody expected trade to continue to grow at that rapid pace. People would very much have expected a moderation as the recovery matured. But what we've seen instead over the last couple of years has really been a sharp drop. And in particular, over the last couple of years, global trade volumes have essentially moved sideways. The blue line on this chart is a global manufacturing purchasing managers index, which is just an index of sentiment among firms that produce manufacturing goods. And it's broadly followed the global trade volumes. But the key point is, again, over the last few years, it's just hovered right around 50. And 50 is generally seen as being the break point between expansion and contraction in the global manufacturing sector. So this has been a very soft economy and a very soft recovery over the last few years. Now, this chart, I think, gives us a little bit more intuition as to what's been going on. Why has the global economy been as soft as it has been? Well, the top red line there gives you Chinese growth over the last couple of years. Chinese growth has been in the process of moderating from 10% pace, where it had been historically, down to something like 7.5%. And there's been a fair amount of uncertainty as well as to whether China was going to have a hard landing or not, and where growth in China would bottom out. Similarly, as Michael has articulated, over the last few years, U.S. growth has been stuck in a 2% growth track, which, given the depth of the downturn in the U.S. during the financial crisis, is a very disappointing recovery. And then probably most concerning of all, the Eurozone has been in a financial crisis, which has pulled down its growth, but I think equally importantly has created a lot of financial stability risks for the global economy more generally. Now, that's the bad news. My feeling is, though, that there's some good news. The good news is that I very much expect 2013 to be something of a year of transition, where the global economy finally starts to put the legacy of the global financial crisis behind it. Specifically, I'd expect that Chinese growth is going to stabilize at about 7.5%. And at 7.5% growth, the Chinese economy can still be a powerful engine of growth for the global economy. I'd expect that by the end of this year, the first half may not be great, but by the end of this year, the US economy is going to be growing at something approximating a 3% pace, and maybe even a bit faster than that in 2014. And sadly, our friends in Europe, I think, are very, very unlikely to see positive growth anytime soon. But what is true is that in 2012, they went a long way toward addressing financial stability risks that could result in major crisis. So the probability of a significant disruption in the euro area is much lower than it was before. Now, what I'm going to do is I'm going to focus in for a few minutes specifically on Europe. And then we'll talk about some of these other regions in Q&A. But I think that putting the situation in Europe into some context here, that the European policymakers have been struggling with, broadly speaking, two kinds of challenges. On the one hand, there are some acute challenges. And when I say acute, I mean challenges that if they're not addressed soon, could very easily blow up in a financial crisis that would bring down Europe and have very negative effects for the rest of the world. The second kind of challenge I call chronic. These are deep, challenging, difficult problems that need to be resolved. But it's not necessary that they be resolved today or tomorrow. You actually have some time to work through them. Okay? So on the acute set, I'd put on there, one, the possibility of a disorderly Greek exit. What did we see in 2012? We saw the Germans make a decision during the fall that instead of facing the risk of a disorderly Greek exit during the year of their general elections, that they'd much rather fund Greece for a few more years. And this decision by Merkel and other German politicians could have been a lot different. It is very possible that German politicians would have come to exactly the opposite conclusion, that in order to sell themselves to their public, they needed to be tough with Greece and put down the line and force Greece out of the euro area. But the fact that they made the opposite decision has significantly reduced what I see as being one of the major financial stability risks for Europe and the world. Second, as Paul mentioned, a big risk was continued source of funding for the Italian and the Spanish sovereigns. What happens if the markets just won't buy Spanish and Italian debt? And the answer now is, well, Mario Draghi's put forth his OMT program, this facility where he's willing to use the ECB's balance sheet to buy sovereign debt under certain circumstances. And the markets have accepted the fact that the ECB is there, and the ECB's balance sheet is providing a credible backstop for the sovereigns in Europe. So this is another source of acute risk that has largely been taken off the table. And then finally, if we had had this discussion a year ago, I would have been very worried about bank liquidity and sources of bank funding. But Mario Draghi, through his long-term refinancing operations, has largely taken that off the table as well. So what does this mean as a practical matter? Well, what it means is financial conditions in Europe are a lot less disrupted than they were before. Here I show you the spreads on Italian and Spanish debt relative to German bonds. And particularly over the last few months, they're down substantially, as I think market participants are increasingly realizing these acute financial stability risks are less present than was the case before. But on the other hand, some of the arguments that Paul was making are also very relevant. Those chronic challenges, whoops, I went the wrong way. Those chronic challenges are still very much in place. Growth and competitiveness imbalances in Europe. Greece and Spain and Italy and Portugal grow very slowly. And Germany is very competitive at current wage rates. So you have growth and competitiveness problems, fiscal imbalances, issues with bank capitalization that remain significant. In the United States, we did a stress test where we looked carefully at US financial institutions and came to some conclusion about where their balance sheets were and how much capital would be necessary to make them solvent. In Europe, they've never done that in the same way. And as a result of that, there is a significant question mark, a continuing question mark about the solvency and financial viability of many of the banks. And in addition, the architecture that's necessary to run a increasingly integrated economy is still in the process of being constructed. So putting this together, we're seeing the imprint of these chronic problems in Euro area economic activity. Economic sentiment in Europe is very weak, not quite as weak as was the case during the crisis in 2008, 2009, but very weak by any historical standard. As a result of the fact that the bank's problems haven't been addressed, we're in a world with ongoing bank deleveraging. And if the banks are deleveraging, trying to reduce the size of their balance sheets, they're not enthusiastic about extending credit. And what do we see? We see lending to firms in Europe is now contracting at the same pace as during the depths of the financial crisis. And lending to households is performing in even a weaker way. And Europe is a very bank-dependent economy. When you see negative credit growth, that's like pulling the lifeblood out of the European economy and is a very negative signal for economic activity. So putting it all together, our view is that the European economy is less crisis-prone than was the case a year or two ago. But we don't see the mechanisms through which Europe is going to grow anytime soon, given credit crunch and bank deleveraging, fiscal challenges, political uncertainties, and that's a key one. Will countries continue to implement the reform programs that are necessary? Just one example of that. This shows levels of GDP for various countries. The dashed line there that starts at 25 and goes down to 0 over the last 5 years, that's Greece. Greek GDP has fallen 25% over the last 5 years. At some point, did the Greeks say, no more, we just can't handle any more pain? And if they do say that, and it would be understandable if they said that, if they do say no more pain, then their economy is left in a place that's unsustainable, over-indebted, and uncompetitive. And if they won't do the program, even if the Germans and the Europeans want to provide funding, it's not possible. That they need some performance on the Greek side. So the political situation in Europe strikes me as really being the key issue. So bottom line, I'm hopeful that 2013 will lead us to something better, but there clearly remain a lot of risks and challenges to be dealt with in Europe and elsewhere. And I'll stop there. Thank you.
We'll start with a dialogue up here, and then we'll open it up in a few minutes to the audience. I'm thinking perhaps the best way to start is to add, you guys covered a lot of material, so they're very nice for this audience. But it might be nice to start off with something that you didn't get to talk about in some depth, but has been getting a lot of attention in the press, namely the developments in Japan. We've seen the government virtually compel the central bank to change its inflation target. We've seen the yen decline rather substantially both in anticipation and after the event. Where are we headed? What are the implications for Japan? What are the implications for central banks more generally?
Do you want me to head off? Okay.
By all means.
I lived in Japan for 17 years. In fact, I think we shadowed each other for a while there, Kim. So perhaps I'll take the mic to lead off with this. I alluded to the key issue for me in Japan in my talk. And the key sort of macro factoid about Japan is that Japan has been in deflation for, depending on how you measure it, depending which index you look at, 10 to 18 years. Maybe on the CPI basis, more like 10. If you look at the GDP deflator, it's actually 18 years. GDP deflator is down 18% in cumulative terms since it peaked in the second quarter of 1994. So when people talk about the lost decades in Japan, for me it's really this macro phenomenon of deflation. By the way, the GDP deflator in the US is up about 44, 45% in that period. That would be the normal picture. So what's going on in Japan is, I think the most important, most interesting fact is, of course, the new administration is coming in and saying the Bank of Japan must work more aggressively, must be more aggressive to end deflation. Now, there's much sort of more here than meets the eye, because what does that actually mean? Well, the other interesting thing about Japan to me is that whereas most central banks in the world have a price stability mandate, which is operationally usually taken to be about 2% measured inflation that they believe that they can achieve over the medium term, the Bank of Japan has adopted a position which basically says, well, the deflation in Japan is not due to insufficiently aggressive monetary policy. That's not the problem. The problem is declining real growth, the aging population and declining potential growth. So the way to get out of deflation is not to sort of run the printing presses or have more aggressive monetary policy, but rather to tackle those problems in the real economy. So structural reform, deregulation, productivity enhancing investments in the economy. So I think what's most interesting with this change in Japan at the moment is, what is the government really up to here? Is the government just going through the motions of saying, well, look, surely you can do more, and putting pressure on them to do so? In which case, pardon me, I don't think really at the end of the day all that much will change, because if you have a central bank that is effectively broadcasting the message, look, we'll try, but don't really look at us because we don't think this is a monetary phenomenon. Well, monetary policy is really supposed to work through the central bank instilling in the public a sense of credibility that the central bank, A, has the tools, and B, is determined to use those tools to achieve the inflation target. So if the Bank of Japan is not going to move down that path, I think we're probably going to go and run in circles a little bit here. But the government has an opportunity in April and in March to appoint a new governor and new deputy governors. And so there's an opportunity to sort of change the Bank of Japan from the top down. There's one other issue here which I suspect you'll come to, Kim, which is something a little bit unhealthy about the Japan situation is that you do have a government which is sort of very loudly putting pressure on the central bank to take certain policy actions. The odd thing is, unlike the old business, remember where the idea was that the central bank was supposed to take the punch bowl away as the party got going, that is, do their job by quelling inflation. The criticism of the Bank of Japan is that it hasn't done its job, and the government is putting pressure on it to, in some sense, do its job.
Go ahead.
I'd love to jump in on this one. This is actually one of the most interesting issues that economists have had to talk about in the last few years from my perspective. It's just captivating from so many perspectives. On the issue that Paul was just discussing about whether putting this pressure on the central bank is the right thing to do, I have to admit that I am exquisitely divided on this issue. That on the one hand, I think that having spent 18 years at the Federal Reserve inside a central bank, that central bank independence is absolutely essential, and it should be held inviolate from the government, and by protecting and defending the central bank's independence, you're going to end up with better economic outcomes over time. But on the other hand, if ever there were a country where it's appropriate for there to be a social and even political debate about the appropriateness of monetary policy, it seems like Japan's that country. As Paul noted, when you look at nominal GDP or the GDP deflator, nominal GDP is lower than it was 20 years ago. And I think it is time for them to have a broad discussion about where they would like the trajectory of economic policy. So how to square those two thoughts or reconcile those two thoughts is very tricky. And if you press me, I'd probably say, well, the key is you have the debate, and it's fine for the government to be involved, but in that process, there are certain lines across which the government should not tread, that there are certain aspects of the central bank's independence that should be held sacred. And I don't think that the government has crossed those lines yet, but it should be aware of them. And let me just two other points fairly quickly. One, will this make any difference? Will the BOJ end up, they'll have a new governor, they'll have 2 new deputy governors as of the spring. Is this going to be a new and improved BOJ that's going to look and feel and act like the Federal Reserve? I have to admit, as somebody, I never lived in Japan, but who's been following the Bank of Japan for 15 years, it stretches my imagination. And I have to say, when I talk to investors here in New York, probably 60-40 are in the skeptical camp. But last week I was in Asia doing meetings in Hong Kong and Singapore, and I'd say that the investors there are probably 2-to-1 in favor of the position that they really think this is going to matter. So this is a very interesting question. There's a debate in philosophy about whether people can change, and this is a debate as to whether an institution can change. And if you are going to change an institution, what does it take? Can you do it by simply appointing 3 key people at the top and having that percolate down, or is it something that's going to require much more time to generate a true orientation of the BOJ? And honestly, I don't think anybody knows the answer to this question. It's very interesting. And then the final question is, will it matter? Even if the BOJ, suppose the BOJ opened up the printing presses, doubled its balance sheet, the yen went to 110, inflation jumped to 2%, would it really make that much difference for the Japanese economy? And my feeling is, based on a little bit of empirical work that I've done, that a 30% depreciation of the yen might lift the level of Japanese GDP by 1.5 percentage points to 2 percentage points over the next few years. So the level of GDP would be somewhat higher. And I think if you could raise inflation into positive territory, you'd eliminate some distortions associated with deflation. I don't know how much that would buoy the economy, but it wouldn't shock me if that was worth a couple of tenths on potential growth or on trend growth, which would mean that Japan would be a 0.75% growth economy rather than a 0.5 percentage point economy. But bottom line is, it doesn't deeply transform Japan. If Japan wants to be deeply transformed, it needs the kinds of structural things that Paul was talking about, and including in that a willingness to open up towards immigration. If there's a single policy that would transform the Japanese economy in the stroke of a pen, it would be greater openness to immigration. Now, I see absolutely no political openness to that, but if they were serious about reinvigorating the economy, I think that's the direction they move in.
Can I just pick up on the last thing that Nathan said as to whether it would matter? What I find a little interesting watching it from over here in the U.S. is that, you know, a lot of economists would say when interest rates are at 0, running the proverbial printing presses shouldn't do anything. That when you're in a liquidity trap, printing more money has no effect. Now, so much of the debate right now in Japan is there too much government interference? Is the institution going to change? But it's interesting what's going to happen. Let's say the government gets their way, the institution changes, you run the printing presses. Will that actually make a difference? Now, if you do get the yen at 110, if you do get inflation expectations way up, then running the proverbial printing presses will have worked. And so far, the markets seem to have believed that. The question is whether, you know, we're going to see any follow through, and I think that's what's going to make it interesting looking, you know, the next couple of years.
Well, Japan's sort of an interesting example. I don't want to go too far down this road, but it's an interesting example because it raises other questions that are relevant in other parts of the world. We have a lot of countries that have high debt levels. Japan's pretty much at the high end of that list, at least among the industrial world. So are there special risks in trying to run a higher inflation rate and raising inflation expectations in a country that has that kind of high debt? Is that really a solution in some sense to their problems?
Same order?
Please, go right ahead.
Well, I think the word that would leap to my mind here is really a policy trap. Has Japan got itself into a policy trap? Debt levels are very, very high. The reason that debt levels are very, very high is because Japan's been running very big budget deficits for a long time now. And I believe that the major reason for running those big budget deficits is that Japan has been in this deflationary funk for about 20 years as well. A couple of ways to look at that. I think I saw the macro identity in this wonderful, the savings investment balance identity somewhere in this wonderful book that you gave me, Kim. But it's a very simple, it's an identity. And if private sector savings goes up and private sector investment goes down, that is net private savings goes up, then that has to be reflected somewhere, either in the external sector, which would mean Japan, and that's what happened in Japan, net savings went up. That means Japan would have to run a bigger current account surplus. Well, they're already running 3 to 4% surplus, so that couldn't really absorb it. The rest of the world couldn't absorb that. So there's only one place it could go, and that was into the budget deficit. So the budget deficit to me in Japan, big budget deficits, has been sort of flip side of this very deflationary environment. So, but there is a kind of a policy trap, because I think one of the reasons perhaps there's been diffidence and hesitation by the monetary authorities, and even including the Minister of Finance sort of in here, fiscal monetary authorities, is the concern that, well, if you change that situation, you're going to lead to higher interest rates, and wow, that could be the trigger that triggers the fiscal crisis. I actually don't think that would happen, because if you look at it in more general equilibrium terms, yes, of course, if Japan reflated and got out of deflation, interest rates would go up, and of course, therefore, debt servicing costs would go up. But the very conditions that were leading to, what were sort of driving the budget deficits, that is very weak tax revenues, and the need for the government to sort of keep pump priming the economy every few years would be taken away. And again, Japan having a very high net level of net savings, net financial assets, I think the markets would look at it and say, okay, that's good. You're getting rid of this chronic deflation, and we think that you're putting the economy on a better path. But it is untested territory. A lot of financial institutions in Japan have got a lot of JGBs on their balance sheets. And so that sort of impact on the financial system would have to be taken into account as well.
Anybody else?
The simple view on this, which is complementary, I think, to what Paul was talking about from a more sophisticated standpoint, is Japanese debt is approaching 250% of GDP. At a financing rate of 1%, that means that servicing the debt is costing them 2.5% of GDP a year. If you're looking at 2% inflation, that's likely to mean bond yields are in the 3 to 4% range, and you're looking at debt service costs on the order of 6, 7, or maybe even more percent of GDP, which from any historical cross-country kind of comparison is a very heavy burden. Now, an asterisk on that is that the vast majority of these JGBs are held by other Japanese citizens, and as Paul points out, Japan is an international creditor. So really the key question is whether politically and socially you can absorb the tax rates that will be necessary to transfer resources from workers, the young people in the society, to banks and older people in society who are holding the JGBs. Is that socially productive and possible? And how much distortion to incentives to work and invest would be generated in that? And that's a very hard calculation. But I think, simply put, I think those are the key issues. The only other little provocative piece here is the BOJ, presumably, in driving inflation up in Japan, would be buying JGBs. And to the extent that the BOJ buys them and leaves them on their balance sheet, that's debt that doesn't need to be serviced by the government. So that's another angle on it.
Let me be a little parochial here and bring it back to the U.S. Your question about inflation targets and high levels of debt. In the U.S., unlike in Japan, the Fed's done a pretty good job in keeping inflation close enough to its 2% target. Right now, it's a little below at about 1.4%, but as I said, close enough. So there hasn't been, much of a. There has been some talk, however, of a few people like Olivier Blanchard at the IMF has suggested maybe the Fed should raise its inflation target from 2% to 4%. Now, in a world of high debt, that actually doesn't, in the case of the U.S., buy you much in terms of running higher inflation doesn't really reduce your real debt burden that much because, as our friends at S&P and other places would point out, the U.S. has a very short average maturity of its debt. So we have a lot of T-bills, a lot of 2- and 5-year notes. Those things are going to roll over pretty quickly. If we get higher inflation, you're just going to have higher nominal interest rates. You're not going to get a lot of saving. So for that reason, Bernanke has thus far ruled out raising the inflation target to try and generate any sort of short-term gains in our interest expense. So I wouldn't think about that in terms of the U.S. outlook as being a really important thing right now.
I'm glad you did the segue back to the United States. Let me do that in another way. Several of you mentioned that you see fiscal risks to your outlook. Let's try and make that concrete. In the next couple of months, we have certain issues that are facing us: the sequester, the need to roll over, to plan ahead, maybe even to implement a budget for the first time in years at the federal level. How do you see that playing out? What's priced into your forecasts, and what do you think markets are expecting?
Okay, for us, we are expecting growth to be slow in the first half of the year, in part because of those increase in taxes I had mentioned earlier. The sequester on March 1st, I think it's really hard, which is the automatic about $100 billion of spending cuts, which will kick in beginning March 1st, roughly speaking. Hard really to say what the market is looking for there, in part because once we got beyond the debt ceiling, in other words, once Congress said, we're going to raise the debt ceiling, we're not going to threaten a default for the government, market breathed a big sigh of relief, and sequester was really a second-tier issue. And so it's hard to say what's priced into the market. I suspect most people are expecting that part of that will get implemented. In terms of thinking about our own view on how this matters, look, right now in the U.S., debt to GDP is probably about 77%, something like that. Over the next 10 years, which is when most of our budget planning in the U.S. is done, you could get outcomes that range anywhere from 80% to 90% of GDP, depending on whether we go the European route and go cold turkey and put in a lot of austerity, or whether we're a little more growth friendly. So that's kind of the range of outcomes. Now you look then beyond from the 10-year horizon out to the 50-year horizon. Well then, regardless really of what we do in the next few months, your debt to GDP is scheduled to increase to about 250%, if not more, of GDP. So I think a lot of this, what we're doing now, have been doing and will be doing in coming months, is really, I don't want to say rearranging the deck chairs on the Titanic, but it's really just kind of window dressing relative to the big entitlement issues, which are pretty much off the table for now. So we're kind of looking at it more on a growth as being a short-term drag on growth, and not really thinking that anything we're going to do in the next few months really matters for the long-term sustainability of the fiscal situation here.
Anybody else?
Well, we've got a mild fiscal tightening in our forecast already. We would be probably a little bit less than Mike, but maybe 0.5%, a little bit more. But we would be expecting the sequester to be sort of avoided. We know a lot about the tax system now, with obviously the first round of the fiscal cliff having been navigated. But we wouldn't be looking for any additional fiscal tightening to be imposed on the economy. And I guess with the fiscal sort of debate in the US, as an Australian who doesn't vote in Australia, I pride myself on that I'm a little bit neutral here. I think the positive to me would be that if you think that restoring the fiscal finances to some semblance of long-term sustainability and health is really the number one policy challenge and issue that needs to be addressed in this country, then I think you should take some comfort from the fact that it's the number one policy issue, and it's almost a political obsession. So I think it's good that the politicians are all around, are onto this issue. There's almost an obsession about it. Now, they disagree about what they need to do. Well, big surprise. Welcome to politics. So the fact that they disagree, that there's different preferences about expenditure cuts and how much entitlement reform to do, etc., doesn't worry me so much, because let the political machine figure about that over time. But the big risk was, and to a certain extent still is, that the failure to agree on those longer term solutions would cause a front loading of fiscal tightening today that would push this very precarious economy into recession. We seem to be dodging that bullet, and I think that's a very positive outcome.
Where my tone is just a little bit different, I think, than my colleagues here, I knew we'd disagree on something, is our forecast is expecting about a percentage point of drag from fiscal policy on growth in 2013. In my personal view, is that's entirely appropriate. And I consider that something of a Goldilocks point. On the one hand, the US economy really does have some serious fiscal problems. And I think it's fine for us to show our seriousness in addressing those fiscal problems by taking a step toward bringing down the structural balance this year. So I think the 1% is fine, but I'm also worried that if we go significantly further than 1%, that we might impinge on some of these positive signs that we're seeing that are pointing to recovery. So I'm happy with 1% of GDP drag, but I'm also very worried, and I'd say it's a meaningful risk to the outlook, that the sequester, this across-the-board cut in government expenditures that's slated to hit starting in March, will actually be allowed to come online. And if that happens, that I think we're at that point looking at fiscal drag probably more on the order of maybe 1.75% in 2013. And that may be more than the economy can bear at this point. So I'd say for me, in thinking about fiscal, the key question is getting it phased right. 1% this year, 1% next year, 1% the year after, that's fine. We've got to avoid sharp contractions that are going to derail some of these green shoots that we're starting to see, particularly in the housing market.
Great. If there are people in the audience who'd like to pose questions, there are microphones on both sides. So please come right up. And just provide your name and affiliation.
Yeah, my name is Jörg Stephan. I am running the rep office of Deutsche Bundesbank here in New York. I would like to make a brief comment on Europe. There have been made a lot of good comments, but from my point of view, a little bit too negative, I would say. So what was the root of Europe's problems were that politicians did not do their homework in some countries. And this is a basic issue. So how do you guarantee that politicians do their homework in all the countries? This can be done in a fiscal union, but this is not a guarantee that politicians do their homework, because also in a political union it is not guaranteed that politicians do their homework. So actually, when we would like to assess how Europe is doing, we should check how they improve their policies. Did we achieve something? I think something has been achieved. So there were some wage cuts, pension reforms, labor market reforms, fiscal reforms, and you can see it all already in the figures. So unit labor costs decreased, current account deficits are lower. So there has some progress made, although we have to say it's not yet enough. So more has to be done. But the question is, I wanted to make this clear. It's not like you have a fiscal union and everything is easygoing. That's not the case. So we have to find a mechanism basically in Europe that guarantees everybody is doing their homework. So that would be my point. Thank you.
Comments from the panel?
I broadly agree with those comments, and the positive signs that he points to are absolutely right. And it is easy sometimes for us sitting on this side of the Atlantic to be very critical of European policymakers. But the task that they're dealing with there is a task that in our country took us literally decades and decades and decades to achieve, of putting together heterogeneous economies, and maybe even less heterogeneous than those in Europe, and forming a common economy out of them. And another perspective on this is there are 17 countries and there are differing perspectives. We're one country, and how long has it been since we've had a budget? So there's plenty of blame to go around, no question about it, and positive developments on both sides of the Atlantic.
Can I just make a comment, Kim?
Please.
I would be the first person to admit that there are lots of challenges in Europe, as in many countries. So, Nathan had his list of, competitiveness, for example, and a whole range of structural issues in Europe's been dealing with. And they should do those things. They're fine and good. But if you're just sort of tuning in and saying, "Oh, I just happened to notice there was this sovereign debt crisis in Europe," spreads have gone through the roof in many of these countries. What's all that about? To me, that is all about having constructed this sort of halfway house, or this monetary union without a fiscal union. And to redefine the problem as, well, that's not the problem is sort of competitiveness, or it's some kind of internal balance of payments crisis, or it's some kind of fiscal crisis. They're, to me, all manifestations of this underlying sort of conundrum. And it is a conundrum because the 17 countries in the Eurozone and the 27 countries in the European Union have entered into a form of quasi-state. It's not a club of 27 or 17 nations. But it's not a federation either. It's not a club that you can just say, oh, I'll join that club for a while, don't like the food anymore, got sick of the entertainment, I'm going to leave. There is no mechanism there is a mechanism to exit the European Union. There is not a mechanism to exit the Eurozone. By the same token, whereas people like myself would say, look, you do need to fix this architecture. That's the key here. Fixing it is not easy. You need 17 governments or 27 governments with the whole union to agree on A, what they are going to do, and B, convince their populaces, in many cases, that they need to get the treaty changes through. So they are really caught between a rock and a hard place. And I think that's why you saw policymakers dig deep last year and really pull out some rather extraordinary rabbits out of their hats.
I think for the next questions, why don't we take 2 or 3 questions at once, and then we'll try to parcel them out to the panel. So go right ahead, your name and affiliation.
Thank you. John Sarushian, MBA 1 here at NYU Stern. And I would like to get the panel's thoughts on the Federal Reserve's recent policy to peg their low interest rates to an explicit inflation and unemployment target. And I want your opinions both in terms of the policy as a whole and the targets that they've set in terms of the 2.5% inflation rate and 6.5% unemployment rate.
Hi, my name's Simone Foxman. I'm a finance reporter for Quartz in the Atlantic. Actually, 2 things. First, there's been a lot of discussion recently about the unintended consequences of quantitative easing, unprecedented central bank policy. There's been specifically some concern about whether such policies are papering over some risks in the financial system. If that is the case, then how will the Federal Reserve and other central banks be able to notice that something is going wrong, if that were the case? Secondly, on Europe, banks own a lot of, banks there are so large, so highly leveraged, and that's because there's some lack of capital market structure. How do you go from the system that there is now to, I suppose, a more sustainable system? What's the process for changing that without causing a really drastic, deep recession? Thanks.
Okay. One more, and then we'll take a few answers.
Mark Harper, I'm an MBA 2. My question is about austerity in Southern Europe. Mr. Sheard mentioned that he didn't think that that was necessarily the right way to go, and I wondered whether he could give an alternative based on the fact that currently countries in Southern Europe have a very limited ability to raise more debt capital and have very high rates of unemployment and a difficulty in taxing their citizens. So how can these countries afford to spend more in order to activate their economies?
Great. Who wants to
I can talk about the thresholds.
jump in?
So regarding the 6.5, 2.5 threshold policy that the Fed put in place last December, before they put that in place, I was publicly advocating that they do that, so I can't really now turn around and speak against it. I do think it was sound policy. Probably doesn't change things all that much. It didn't really change market perceptions too much of when the timing of the first interest rate hike would be. But it does allow the Fed, I think, an ability to communicate without sounding quite as negative in talking about how long they're going to have to keep rates low. Instead, they can be a little more affirmative in terms of talking about getting back to full employment. Now, the actual target, 6.5, 2.5, which should they've gone to 7 and 3 or 5 and 1/4, and some other numbers that have been thrown. I think that's really tough to say. I think 6.5, 2.5 seems to balance the risks to me pretty well. And one of those risks, if I may, the other commentator or questioner asked about financial imbalance risks. We've been hearing about this really since 2008 when the Fed first put in place zero interest rate policies. And so far there have not been, I don't think, imbalances developing. We haven't seen, I don't perceive major financial risks. The Fed does now have a lot more regulatory and supervisory responsibilities than they did before the crisis. So I think they do have the tools to kind of look into banks and into financial institutions' balance sheets with a little more detail than they did in 2007. So thus far, I'm maybe I sound a little too blasé, but I think the risks are manageable in terms of the financial imbalances.
Want to take the austerity question?
Yeah, but just a word on the Fed as well, because I'm a big fan of the Fed and what the Fed did last year as well. But I think I just put it in a broader context here. We've talked about quantitative easing and we sort of talk about printing money. But I think it's the way that I would conceptualize quantitative easing is simply, in a nutshell, it's what central banks do when they hit the zero bound. If you believe in the inflation targeting regime, then central banks have to have some tools to fight high inflation, but they also have to have tools to fight disinflation or the threat of an outright deflation. The problem is, as everybody knows, in one direction, you don't have unlimited interest rate ammunition. You quickly hit the zero bound. So the central bank will need, at the zero bound, some tool that it can use to try to ease financial conditions, ease monetary conditions, and try to stimulate the economy a little bit more in order to achieve its objective if it's in a situation where it's hit the zero bound and it's not meeting its objectives. Well, that's quantitative easing. And the way quantitative easing works is essentially the central bank buys assets and pays for those assets by creating reserves. And the assets that it buys are not the same asset as the asset that it supplies. So it's engaged in a kind of substitution with the portfolio of the private sector. And in a nutshell, the central bank is able to unilaterally change the composition of the aggregate portfolio held by the private sector in the direction of creating easier conditions. So that's great. It's great that they have that tool. Then they have to decide, well, when and how do you use it? Well, what the Fed decided last year was it said, you know what, the economy is still not strong enough and recovering as strong as we would like it to do, and therefore we need to ease further. And they did two things. They honed their forward guidance, which is one way of easing conditions, but then they backed it up with some oomph, which is the renewed asset purchases. So I think it was a good move, but the interesting thing from a somewhat more theoretical perspective, I guess, is long run Phillips curve, vertical. The Fed historically would have argued, I think, Nathan, that, yeah, we have a dual mandate, but it's really just like one mandate, which is inflation. Because if we're achieving our inflation target, or if we're going after our inflation target, the employment mandate, full employment mandate, will take care of itself. And that's a kind of an argument that's probably true in normal business cycle conditions, but when you're in these very extraordinary conditions such as we're having at the moment, where inflation is well anchored, well subdued. In fact, as Mike said, it's actually dipping down again. A little bit of a worry, actually. So there's no threat of inflation, but unemployment is staying very, very high. I think the Fed asked itself, do we have some tools that we could use more aggressively to try to speed things up a little bit? And that was the answer they came to, and I support that. Now, the austerity stuff, take a long time here, but let me just quote a number here. Look at a country like Italy. GDP in Italy fell 7.1% in the financial crisis, or the recession. 7.1%. Since then, it's increased by 0.3%. It's still almost 7% below the peak. What about Germany? Well, Germany took a hit as well. German GDP fell by, I think it was 6.8% in the crisis, not quite as much as Italy. It has increased by 9.4%, and the level of GDP in Germany stands 2 percentage points above the pre-crisis peak. Germany is also running a current account surplus of about 6% of GDP. My point would simply be that these countries in the periphery are in this very difficult situation, and then they're being told, you can't depreciate your currency because you don't have one anymore, you can't use monetary policy because that's in Frankfurt, and please engage in fiscal austerity. That's not a pro-growth agenda. I think, and again, this is easier said than done, but if the Eurozone countries, and particularly Germany, had been able to somehow get over the psychological barrier of extending a fiscal helping hand to their southern neighbors, that would have been a much better solution here, to have cut them some fiscal slack for a while and said, we don't like big deficits, but we do understand you're going to need to run bigger deficits for a while in order to get the economies moving again. Once we've got them moving, then we'll deal with some of these longer-term structural issues.
Nathan, there was one more question.
Yes. Let me just make a couple of quick points. Yeah. So it's not immediately clear to me that Europe needs to evolve to a system that's less bank dependent and more intensive in its use of capital markets. I think the bank model over time is likely to prove as robust and resilient as the capital markets model. And indeed, it may be that we find that 10 years hence, the US economy is actually a little bit more intensive in its use of banks and less so in markets relative to pre-crisis. And in particular, I'm not sure that the securitization markets are ever going to come back to where they were before the financial crisis erupted. So there's a lot of work to do on the European banks in terms of recapitalizing them and thinking through business model issues and how they're going to make money going forward. But I really think that a bank-based model where banks engage in old-fashioned banking behavior of taking deposits and making loans can be very profitable for the banks themselves and a very powerful engine of growth in the economy. So I don't necessarily see a huge transformation of the European system of finance. On the margin, it may be a little more capital market intensive, but I think on the margin, the US may be a little less so. And then just two quick comments on the targets. I think the broader point is what you're seeing there is the Fed's commitment to enhancing its communication strategies. If there's one thing that I think really energizes Ben Bernanke and Janet Yellen, and in addition, some of the staunchest doves and staunchest hawks on the FOMC, it's a desire to be more clear about policy and where policy is headed. And I think they very much see these thresholds of 6.5%, 2.5%, as an effort to make the reaction function of the Fed more clear. And instead of people trying to figure out what's the Fed going to do based on a line in an FOMC statement, well, they know how the Fed's going to react, and then they have to think about how the economy is going to perform. And based on their expectations for the economy, they make their investment decisions accordingly. And then finally, on the point of austerity versus pro-growth policies, my feeling is that many of the peripherals were in such weak fiscal position that they really had no choice other than to do some fiscal. But my criticism of the IMF programs is I would characterize those programs as being two parts fiscal austerity and one part structural reforms that would be designed to raise levels of productivity and make the economy more productive. And if I had been writing those programs, I would have suggested 2 parts structural reform and 1 part fiscal austerity. So I think they got the proportions wrong.
I think we've got time for one question and one quick answer. So you're it.
Okay. My name is Zico Sun. I'm a graduate student in a finance major. I have a question on inflation. There are several components to it. I got the impression that at the moment the inflation in the US is kind of surprisingly low. I would like to know how mechanically is this achieved given the increase in money supply through the several rounds of quantitative easing. And secondly, how does this high money supply, low inflation phenomenon affect the inflation in China and other external major US government debt holders?
Okay, we're going to have a 1-minute answer to that one.
Let me take the first part and then hand over the China aspect. As I mentioned earlier, so normally printing a lot of money creates a lot of inflation. When interest rates get to zero, the rules change. Interest rates are near zero, so the Fed's printing of money isn't going to have quite the same effect on the economy. It's not, normally it prints a lot of money and interest rates go down. Interest rates are pinned at zero. More money it prints does not necessarily create more inflation. What right now is driving inflation is the fact that we have a lot of excess capacity in the economy, and that's keeping wages low and thus inflation low. At some point, that excess capacity will get used up. If the Fed left that money, so to speak, in the economy, then that would turn into inflation. But hopefully, when we get to that point, which won't happen in the next few months, but maybe in the next few years, hopefully when we get to that point, the Fed can take out the money to prevent inflation from picking up.
Here's how I would sort of understand that and I think you're sort of, money supply goes up, surely, inflation goes up. Well, first of all, you have to be very careful what money supply you're talking about. We're talking about bank reserves here. We're talking about quantitative easing. That's not the same thing as M2, for example, going through the roof because there's a lot of credit creation going on in the economy. So there's a very particular kind of money that's growing here, and for a particular reason. There are two determinants of inflation, in my view. One is, probably the most important, is how credible is the central bank at anchoring expectations around its desired inflation target. The Fed targets 2% inflation and is very credible and very successful at anchoring expectations around that level. The second one is the conditions in the economy, call it the output gap. If you have a bigger output gap, then you're going to have some downward pressure on inflation away from that 2%. The fact that the Fed has been prepared to defend its target of 2% from the bottom, Volcker defended it from above, Bernanke has been defending it from below in fighting the threat of deflation or outright disinflation or outright deflation, actually gives you more confidence that they are determined to meet their 2% inflation target. And that's why we have this explosion of the Fed's balance sheet, but we don't have inflation. You shouldn't expect inflation because what the Fed is doing, it's doing it because it's showing the world that it's determined to meet its inflation target. Why would you expect inflation under those conditions? How it would affect China, long story obviously, but if the US is successful in getting the economy growing faster, a stronger economy, that will be good for China because China exports a heck of a lot of stuff to this country.
I have to say something here. So I very much agree with Paul's model that inflation determination is broadly about inflation expectations and slack. Inflation expectations are rock solid today, and there's lots of slack in the economy today, so inflation risks are de minimis. But is that always going to be the case? And I think that poses the challenge for the Federal Reserve in the years to come through the exit. And it is going to be a challenge for them with this amount of liquidity in the system. In terms of linkages to China, certainly U.S. demand is a main one. And I'd say the other key linkage is the exchange rate. So as long as the exchange rate is relatively stable, given China's link to the dollar, the impact of the U.S. economy is more limited. If the dollar started to fall sharply, say, because U.S. inflation was rising, then that would have important implications for China. But I really see the key link is the exchange rate and U.S. demand.
Well, I hope you'll join me right now in thanking our panel.